I recently bought a membership for a fitness startup that allows me to pick the workout I want to do and the time I want to go for it. And I love this flexibility. So I'm shooting this video a bit late in the evening, and after we wrap this, I'll head straight for a class. But I'm still figuring out which are the best workouts, and so if you have some suggestions, do share in the comment section. Now when it comes to mutual funds, Flexi Cap Funds have the most flexibility when it comes to their investment mandate. They can invest anywhere they want and in any proportion. Compare this with other equity categories which have one or another restriction. For instance, large cap funds must invest at least 80% of their corpus in large cap stocks, and mid and small cap funds must invest at least 65% in mid cap and small cap stocks respectively. So given this flexibility, Flexi Cap Funds should be best placed to profit from market trends and phases, right? And it may feel that all you need is just one Flexi Cap Fund and probably not separate large, mid and small cap funds. Our Flexi Cap Fund should be able to take care of all the requirements. But does this theory translate into real life? Well, that's we will discuss in this video. Hello and welcome to ET Money's YouTube channel. Today we are going to analyze Flexi Cap Funds. We will look at how they invest your money, how they have performed, and what are your alternatives if you don't want to go for Flexi Cap Funds. But before I start, an important update. We have recently launched our WhatsApp channel. You can search for it on WhatsApp or click on the link in the description to get access to the most insightful content. So this video is divided into three sections. What has been the market cap allocation of Flexi Cap Funds? In other words, how have they invested across large, mid and small caps? Number 2, how has their performance been? And 3, what are the options if you want to go beyond Flexi Cap Funds? So let's start. To understand where Flexi Cap Funds have been investing, we looked at the market cap allocation of the Flexi Cap Funds for the last 6 years as of September and 2023. As you can see, the average allocation to large caps stand at around 65%, although it has fallen below 60% for the first time in the last 6 years recently. But still, it is clear that Flexi Cap Funds love large cap stocks and that they don't shift their allocations towards mid and small caps as opportunistically as you might want them to. This trend is even more pronounced in the top 10 Flexi Cap Funds by AUM, with average allocation to large cap being 69%, with the lowest being around 66% in last 6 years. Now this is possible because a large AUM makes it difficult to invest in mid and small caps. The reason for this difficulty is the less liquidity in mid and small caps, especially small caps, that makes it difficult for a fund manager to buy or sell a large quantity of their stock. A large buy or sell order can make the stock price shoot up or tank, resulting in fund manager not getting the desired price easily. But what about the smallest Flexi Cap funds? They should not face this challenge, right? Or do they also shy away from mid and small caps? While the average allocation to large caps is about 64% on average, so they are putting relatively less in large caps, still it would be safe to suggest on average, Flexi Cap funds historically have maintained a healthy large cap bias. So it appears that the love for large caps is quite universal when it comes to Flexi Cap funds. Now, has this affected their performance? Let's see next. Given the higher allocation of Flexi Cap funds to large caps, it would be worthwhile to check how these funds have done vis-a-vis Nifty 50, which is a purely large cap index. Intuitively, Flexi Cap funds should do better thanks to their mid and small cap allocation. But how much better? To find the answer, we check the average 3-year rolling returns of Flexi Cap funds and those of Nifty 50 TRI between September end 2018 and September end 2023. Rolling returns measure performance across all the specified periods within a time band. In this case, the specified period is 3 years and the time band is September end 2018 to September end 2023. These returns are then averaged to arrive at the average 3-year rolling returns. Now, as you can see, on average, Flexi Cap funds have delivered 20.4% while the Nifty 50 TRI has managed to deliver 18.71%. So Flexi Cap funds have outperformed the Nifty 50 TRI by about 2 percentage points. Now, let's also take a look at the long-term returns picture of Flexi Cap funds versus the Nifty 50 TRI. Fortunately, Flexi Cap funds weren't affected much by SEBI's reclassification exercise in 2018 and they have existed in their go anywhere form for a long time under different names. Until 2020, they were called multi-cap funds and since then, they were renamed as Flexi Cap funds. Now, the average 5-year rolling returns of Flexi Cap funds between September end 2013 and September end 2023 stands at 12.7%. And with 12.14%, Nifty 50's returns aren't much behind. So if someone invested in the Nifty 50 instead of a Flexi Cap fund, on average, they wouldn't have missed much. Of course, the Nifty 50 has been slightly less volatile as well. In terms of the standard deviation of the 5-year rolling returns, Nifty 50's volatility stands at 3.55 as against Flexi Cap Funds 3.62. Last but not least, investing in Nifty 50 TRI is also low on effort. You don't even have to check its performance from time to time, as you would need to with active Flexi Cap funds. So it appears that Flexi Cap funds may have missed the opportunity to create higher wealth for their investors when they could have profited more from mid and small caps. Over the last 10 years, as of September end 2023, the Nifty Mid Cap 150 TRI has delivered annual returns of 22.3%, while Nifty Small Cap 250 has given 20.9%. During this period, the Nifty 50 has gone up by 14.2%. Given this, are there any options that can deliver better returns while providing ample diversification as well? Of course there are. Let's see them now. So if you want your diversified equity fund to have a better representation of market caps, you have two options: large and mid-cap funds and multi-cap funds. Now, large and mid-cap funds must invest at least 35% of their corpus each in large and mid-caps. So at all times, they will be invested at least 35% in mid-caps. The chart on your screen shows the market cap allocation of large and mid-cap funds in September 2018. But there is a problem. Even these funds don't seem to be taking high exposure to small cap segment. Their allocation to small caps have stood at an average of just 8% over the last 6 years. But these have done better than Flexi Cap funds in terms of 3-year rolling returns. So possibly, the mid-cap allocation of these funds have worked to their advantage. The next option is multi-cap funds. These funds are mandated to invest at least 25% each in mid, large and small caps. So at any time, you are assured of a sizable allocation to market caps. But what about the returns? Well, the multi-cap category came into being only in January 2021. So we don't have much return data for them. Still, in terms of calendar year returns, multi-cap funds have done better in 2022 and 2023 as of September end. Since these funds lack a history, in other video we did a simulation analysis of these funds. You can find the link of the video in the description. Last but not the least, another option for you to have a better market cap representation in your portfolio is to invest in large, mid and small cap funds in the required proportion. For instance, one may like to invest 50% in a large cap fund, 35% in a mid cap fund, and the rest 15% in small cap funds. The portfolio can then be rebalanced from time to time to restore the market cap allocation. But do remember one thing, doing this rebalancing on your own will lead to some taxation. And another note of caution, while large and mid cap funds and multi cap funds may have a better return profile, they also have higher volatility. That's natural given their higher mid and small cap exposure. So do keep that in mind. So let me share with you the key action pointers from this analysis. If you invest in a Flexi Cap fund, expect it to have a large cap bias at most times. On average, a Flexi Cap fund can deliver better returns than the Nifty 50 or a large cap fund, but expect the return differential to be small. You can even explore a Nifty 50 index fund in place of a Flexi Cap fund if you want a less volatile and simpler portfolio. If you do want your Flexi Cap fund to be more agile with the market cap allocation, maybe go with a smaller AUM ones. But don't compromise on the quality of the fund for the sake of a smaller AUM. Large and mid-cap funds can be a better substitute for Flexi Cap funds, and they must have a mid-cap allocation of at least 35% in all times. Based on your needs, you can opt for large and mid-cap fund or multi-cap funds. Large and mid-cap funds don't invest in small caps, which are more volatile. Multi-cap funds are even a better option, as they promise a sizable allocation to all market caps at all time. But the limited track record of these funds is a dampener. You can allocate corporates across large, mid and small cap funds in the desired proportion and then rebalance the portfolio from time to time. This will ensure that your market cap allocation is as per your requirements. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, do share it with your friends and family. I will see you with another insightful video very soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.